Okay, so the first concept that we are studying is profit maximization. So in this, we will get an output. We should get the same output since this will give us the maximum profit if profit occurs and minimum loss. So whatever we do, we have to operate in this output itself. And how will we get this output? We'll get this output using two conditions. First one is marginal cost is equal to marginal revenue, and second one, marginal cost curve cuts MR from the below. Like here, marginal cost and MR should meet, and it is cutting it from the below. So this is the output region. So now we're going to see of how we're going to determine profit or loss. That is using average revenue and average cost. So if average revenue is more than average cost, that is called as super profit. If it's equal, then it's called as normal profit. But why? You will understand seeing this, because when we're calculating average cost, we see the factors of production, right? We'll add up all the factors of production. Here we added land, labor, capital, and see, here we're adding entrepreneur's profit. So in this average capital, there's already profit involved. So that is why it is normal profit. And now we're gonna see if revenue is less, then it is a loss. And in loss also, we have a tendency, so whether should we continue the business or not, even though we're having losses right now, that we can conclude using average variable cost and average revenue. So if average revenue is more than average variable cost, we can continue. If it's equal, then you have to decide. It's called a shutdown point. You have to decide whether you should carry on or not. And then when it is less, you have to shut down the business. Now we're going to see the graphs of each of the following. Before moving on, I'll show you the case of why should we continue in the loss, even though it's a loss or not. So in this case of the pani puri, the cost per plate is 7 rupees, but the average revenue per plate is 10 rupees. See, first you'll get the loss and then you'll incur profits. So that's why you should continue in case where average revenue is greater than average variable cost. Now coming to the graphs, first one, we're going to see how much output we should do. So this red line here shows us the output. And then we have the marginal revenue line, average revenue, and then marginal cost. See, using these two and the intersection, this point, it tells us how much output. And afterwards we craft the average cost and average revenue curve. And on the output line, check whether average cost is above or below or on average revenue. So here in this case it is below. This means we are getting super profit, and in this case both are equal. So on the line of output, so in that case normal profit, and here average cost is very high compared to average revenue. That is why it is loss. Okay. And again, whether to shut down or not, you can see using the average variable cost curve, this red line. If it is greater than average revenue, which is the green line, then you should shut it. Similarly, you have to see the others as well. So after this, we learned about market. What's a market? Types of markets, classification of market. And then we land upon perfect market. Perfect competition market. So in perfect competition market, you know that all the prices are equal, because of which, see, the marginal revenue will also become equal. So in this case, price is equal to average revenue, and which is equal to demand curve, like we know, but in this case it's also equal to the marginal revenue, and this will be their graphs. And since the price is equal in perfect competition, the price is set by the market. And by how? By this equilibrium concept of demand and supply. Demand supply accordingly, price will be set, and that will be followed by the firm. And this is the case that will be used in perfect competition. Now we're going to see the graphs of how our previous way of determining profit and loss works in the perfectly competition market. See, we're going to see how to determine profit and loss using average revenue and average cost using in the perfect competition market. First, we have the MR, and this is MC. So here we get the output line. After this output line, this is the AR line itself. You will take the AC. Since AC is higher, this will give loss. Similarly, it will give what? Since it's equal, normal profit, and this will give super profit. And here put average variable cost and see if you should continue or shut down the business. One note point that you will have to see here is that in case of perfect competition, we know that AR is equal to MR is equal to price, which is equal to demand, since AR is equal to demand from the beginning. If AR can be demand and this is MR, then MC must be supply. So demand is equal to AR, which is equal to MR, and supply is equal to MC. But this is in the case of perfect competition. Another note point is that भले ही शॉर्ट रन में कितना भी नाच लो प्रॉफिट, सुपर प्रॉफिट, नॉर्मल प्रॉफिट और लॉस, लॉन्ग रन में जाके तुम्हें नॉर्मल प्रॉफिट में ही जाना पड़ेगा. क्यों? क्योंकि उसका रीज़न ये है कि when you're facing loss, all the markets will take out the supply, because of its price will become less, and more growth will happen and will come to the normal profit stage. When you go to the super profit stage, then everybody will start coming into the same market, then prices will become less comparatively, and then again you'll come and fall into the normal profit range. That's why कितना भी नाच लो, फिर लॉन्ग रन में नॉर्मल प्रॉफिट में ही आना पड़ेगा.